Current price action for Plug Power Inc., Nasdaq PLUG, is sitting at precisely $2.24 USD, trading up by 0.8 cents per share, which translates to a 3.70% gain for the session so far. If you are watching the tape today, you are seeing a stock that is fighting tooth and nail to reclaim relevance in a market environment that has become increasingly hostile to speculative growth assets. The intraday chart shows a classic battleground scenario. Buyers are stepping in at the $2.15 level, creating a temporary floor, while significant sell walls appear every time the price attempts to break above $2.28. This isn't just random noise. It is a tug-of-war between retail optimists utilizing platforms like Robinhood stock trading apps, hoping for a short squeeze, and institutional algorithms on interactive brokers trading platforms that are fading the rally, betting that the fundamental cash burn will eventually drag the price lower. The expectation for Plug Power has long been that it would be the Tesla stock of the hydrogen sector, a first-mover giant that defies gravity. The reality, however, is far more grounded and gritty. The reality is that Plug Power is currently navigating a survival phase, trying to bridge the gap between massive capital expenditures and a timeline for profitability that keeps sliding further into the future. When you look at the volume today, it is tracking slightly above the 10-day average, which suggests that this 3.70% move isn't just a hollow drift upward. There is actual accumulation happening. But who is buying? The data suggests a divergence. We are seeing smaller lot orders, typical of individual brokerage accounts, perhaps users on SoFi Invest or those managing their own Schwab Intelligent portfolios, stacking up on the bid side. These investors are likely reacting to the optical cheapness of the stock. A few years ago, this was a $60 stock. Today, at $2.24, it looks like a bargain to the untrained eye. However, the smart money flowing through Fidelity Investments and Fidelity Wealth Management desks is much more cautious. They aren't buying the dip because it's cheap. They are watching the bond market, interest rates, and the political landscape in Washington, which has complicated the green energy narrative significantly in late 2025. Let's address the elephant in the room immediately: the Department of Energy loan guarantee. This was supposed to be the lifeline. The expectation was that the $1.66 billion DOE loan would finalize smoothly and fund the construction of green hydrogen plants across the country, securing Plug's future. The reality has hit investors like a bucket of ice water. With the political shifts in Washington following the 2024 election and the new administration's scrutiny of green energy commitments, Plug Power has had to suspend activities related to this loan facility. This is critical. The market hates uncertainty, and right now, the government backing that was priced in as a sure thing is now a giant question mark. This suspension forces the company to look for alternative capital, which usually means one thing: more dilution. If you are holding shares in your Fidelity IRAs or through a Fidelity brokerage account, you know that dilution is the silent killer of long-term returns. The share count has already ballooned by over 50% in the last year alone. Every new share issued to raise cash makes your slice of the pie smaller. However, just when the narrative seems entirely bearish, Plug Power throws a curveball that keeps the bulls in the game. The company recently secured a contract with NASA to supply liquid hydrogen for the Glenn Research Center and the Neil Armstrong Test Facility. While the financial terms of $2.8 million aren't going to fix the balance sheet overnight, the symbolic weight of this deal is massive. It validates the technology in the most demanding environment possible: aerospace. If NASA trusts Plug's liquid hydrogen, it makes it much harder for critics to claim the technology doesn't work. This creates a fascinating tension. The financials are screaming caution, but the technological validation is screaming potential. This is why you see such high volatility. It is not just about numbers. It is about belief systems clashing in real time. Speaking of numbers, we need to look at the recent Q3 2025 earnings report because it tells a story of a company that is trimming the fat but shrinking in the process. Revenue came in at $177 million, which was a miss against the forecasted $187 million. The growth engine is sputtering slightly as they pivot away from low-margin equipment sales. However, there was a silver lining that the bulls are clinging to. The earnings per share (EPS) beat expectations. They posted a loss of 12 cents per share against a forecasted loss of 13 cents per share. It sounds minor, but in the world of algorithmic trading, a beat is a beat. It signals that management is finally getting a handle on their operating costs. They are burning less cash to keep the lights on. This is likely due to Project Quantum Leap, their internal initiative to streamline operations. If you use a Fidelity mobile app to track earnings, you might see that green EPS beat and think everything is fine, but you have to dig deeper. The revenue miss indicates that demand for hydrogen electrolyzers is lumpy and unpredictable. The broader context here involves the hydrogen economy itself. We're seeing a delay in the widespread adoption of green hydrogen, partly due to high interest rates making capital-intensive projects more expensive. If you are looking for online investment opportunities or browsing investing sites, you've probably noticed that the entire clean energy sector is under pressure. Solar, wind, and hydrogen are all capital-heavy sectors. When money is expensive, these companies suffer. Plug Power is effectively a construction company wrapped in a tech stock valuation. They are building massive plants in Georgia, Tennessee, and Louisiana. That costs billions. When the cost of borrowing rises, their path to profitability extends. This is why you see comparisons to Tesla stock fall flat. Tesla scales with software and chip design, high margins, low capex relative to revenue. Plug scales with steel, concrete, and electrolyzers, low margins, massive capex. A better comparison might be the early days of Tesla stock, when the company was weeks away from bankruptcy while trying to ramp up Model 3 production. The difference is that Tesla had a consumer product that people were lining up to buy. Plug has industrial customers who are slow to move and highly sensitive to price. Let's pause for a second. I want to hear from you. Comment below how many shares of Plug Power you currently hold and what your average cost basis is. Are you averaging down at these $2 levels, or are you waiting for a confirmed breakout? I am seeing a lot of chatter on social media about people stuck in the $10 or $20 range hoping for a miracle. Let me know your position size. Now, let's look at the institutional landscape because this is where the real game is played. Despite the retail enthusiasm you see on the Robinhood app or discussions about Robinhood crypto users diversifying into high-risk stocks, the big boys are actually accumulating. Recent filings show that BlackRock and Vanguard have increased their positions. Why would they do that if the company is burning cash? Because they are playing a different timeline. They aren't trading the daily chart. They are looking at 2030. They know that if the world is going to decarbonize heavy industry, shipping, steel, cement, batteries won't cut it. You need molecules. You need hydrogen. Plug Power is one of the few pure-play assets that gives you exposure to that theme. For a massive fund manager at Fidelity Investments, putting 1% of a portfolio into PLUG is a call option on the future of energy. If it goes to zero, it's a rounding error. If it goes to $50, it makes their year. This asymmetry attracts institutional capital even when the fundamentals look ugly. However, for the individual investor using self-investing tools or seeking investment help, the risk profile is totally different. You cannot afford to treat PLUG like a call option if it is 20% of your portfolio. The risk of total capital loss is non-zero. The company has a massive accumulated deficit. They are relying on going concern warnings being resolved by raising more cash. We saw them raise capital through at-the-market offerings, which is just a fancy way of saying they are selling new shares directly into the open market, diluting you and me. Every time the stock rallies on good news, the company likely sells into that strength to fill the war chest. This creates a sell-the-rip dynamic that caps the upside. If you are using Interactive Broker's stock trading tools, you can see the sell orders hitting the tape every time we approach resistance levels like $2.50 or $3. What is the company actually doing to fix this? They are pivoting. The old Plug Power was about growth at all costs, selling forklifts to Amazon and Walmart, sometimes at negative margins just to get the foot in the door. The new Plug Power, under the pressure of this market, is trying to become a vertically integrated energy company. They want to produce the hydrogen,